I'm sure you heard about this.
Would you like a bank account that pays you 11% that's tax deferred?
11% is a huge number.
It may sound too good to be true.
You can't keep doing it forever. And then the whole thing collapses.
Some are calling it the iPhone moment of the Bitcoin industry. Others are comparing it to the infamous Terra Luna Ponzi scheme. I'm talking about STRC or Stretch, a stock issued by Strategy that offers double-digit returns with minimal volatility. Michael Saylor recently suggested that the company could sell Bitcoin itself in order to pay those dividends, which raises the obvious question: how sustainable is this mechanism? In this video, we are going to break down what STRC actually is, how it works in practice, and most importantly, what could go wrong with it. Before we start, if you enjoy our content, don't forget to like the video and subscribe to our channel. Also, this video is for educational purposes only and does not represent financial advice. Let's start with the basics. STRC is a perpetual preferred stock issued by Strategy in July 2025. Unlike common Strategy shares, STRC isn't designed to go up in price. Instead, it's meant to stay roughly around $100. Its main purpose is to generate income through dividends, until now paid monthly, but soon probably moving to twice a month. Those dividends are currently over 11% annually. That's far more than most traditional yield-bearing financial products. Now, the dividend is not fixed. It can be adjusted in order to keep the price of STRC stable. If the price starts rising above $100, Strategy can lower the dividend, making it less attractive and pushing the price back down. If the price drops too much, they can increase the dividend to attract buyers. Because of its price stability, STRC feels less like a stock and more like a high-yield savings account or a bond. Now, where does that impressive yield come from? Well, STRC is a core part of Michael Saylor's Bitcoin accumulation strategy. The idea is simple. Strategy issues STRC and other financial instruments to raise capital, then uses that capital to buy more Bitcoin while also funding the yield attached to STRC. During a latest earnings call, Saylor revealed something new. Strategy could eventually sell some of its Bitcoin to help fund that yield. And that could have major implications. But we'll come back to that in a moment. Saylor recently bought over $2 billion in Bitcoin, primarily via STRC sales, pushing his holdings above 4% of total supply. Critics argue this model is unsustainable. They say there is no real underlying business or cash flow backing the yields, which is true. The money ultimately comes from new investors buying Strategy shares. CoffeeZilla has recently criticized STRC, pointing out that the risks aren't clearly communicated. He even compared it to a Ponzi scheme like Terra Luna, which was offering around 20% yields before it collapsed. Now, let's be clear, STRC is not a Ponzi scheme, and here is why. STRC is a regulated financial security listed on the Nasdaq. It is issued by a public company with a real asset backing it, Bitcoin. Most importantly, the balance sheet is transparent for everyone to see on the company's website. There is no hidden mechanism where new investors' money is secretly used to pay old investors. That makes it fundamentally different from a Ponzi. That being said, being legitimate doesn't automatically mean it's safe or that it's for everyone. And that's an important point CoffeeZilla and other critics are making. The way STRC is marketed can sometimes be misleading, especially in video ads like this one.
Vacation here?
I live here. I'm retired. I worked hard as an engineer to save money. Again. Then I put my savings into Stretch.
What is Stretch?
Stretch is a stock. Right now I get about 11% a year in dividends. Nice.
It's the stretch, yeah, the stretch, 11%.
Or this other one.
When your dividend is at zero, this is like a normal checking account. You can't hear anything. How about we turn it up to 3%? Well, this is like a money market. Pretty boring. At 10%, this is awesome. But then there is Strategy. You see, the numbers go to 11. We can stretch all the way up to 11%.
The way it's promoted, STRC can sound almost like a savings account, just with much higher returns. But that's not what it is. So before anyone considers investing in STRC, it's important to understand the risks, which, by the way, are clearly explained in the fine print on the company's website. First, no maturity. STRC is a preferred perpetual stock, meaning it has no maturity date. That means you can't get your money back on demand like in a savings account. You can only sell the stock on the open market. Second, that 11.5% yield is not guaranteed. It can be reduced or even suspended at any time if things go south for strategy. By the way, that's also what makes it different from a Ponzi, where returns are usually guaranteed. Third, STRC is not collateralized by Bitcoin. That means in case the company goes bankrupt, you have zero claim over the underlying asset. Fourth, and that's the most important risk, the yield ultimately depends on a single asset, Bitcoin. Not directly because Bitcoin doesn't generate cash flow, but indirectly through strategy's ability to keep raising capital, which in turn depend on investor demand for Bitcoin exposure. And this is where things get tricky, because if Bitcoin crashes too low for too long, interest in the company's stock could decline, making it harder to raise new capital. Critics say that in a worst-case scenario, this could eventually force the company to sell its Bitcoin to meet its obligations, potentially triggering a negative spiral. And here is where the latest earnings call comes into play. Saylor said that Strategy could potentially sell some of its Bitcoin to help fund the STRC dividend, and that immediately spooked a lot of people. After all, for years, Saylor's mantra has been simple: never sell Bitcoin. Now, polymarket traders are pricing in a high probability that Strategy could sell Bitcoin sometimes in 2026. In an attempt to calm investors, Saylor clarified that Strategy would only sell Bitcoin if doing so were accretive to shareholders, meaning it would increase shareholder value rather than hurt or dilute it. He also said Strategy will always remain a net buyer of Bitcoin. In simple terms, instead of relying only on issuing new shares to fund the dividend, Strategy would also have another tool available, its Bitcoin holdings. So that's really the key argument Saylor is trying to convince the market with. There is a huge difference between strategically selling small amounts of Bitcoin when it makes financial sense and being forced to dump Bitcoin as a last resort to avoid insolvency. At least for now, that second scenario looks unlikely. Strategy has a strong balance sheet with more than $2.2 billion in cash reserves and relatively low leverage. Also, in case of emergency, Strategy can always halt or delay dividend payments to avoid insolvency. Even with Bitcoin falling by almost 50% in the latest bear market, the company continued paying out dividends and accumulating Bitcoin. So where does that leave us? STRC is fundamentally different from a Ponzi scheme like Terra Luna. It's backed by a real asset, Bitcoin, and operates in a transparent, regulated framework. It is basically a leveraged bet on Bitcoin outperforming fiat money. That said, the concerns raised by critics like Coffee-Tilla aren't baseless. They highlight how the product can be perceived as safer than it really is. If you have some spare cash and strongly believe in Bitcoin long-term, STRC might be an interesting way to generate passive income. But if you are living paycheck to paycheck and looking for something low risk and predictable for your life savings, this probably isn't the right choice. And now I'm curious, would you put your money into STRC? Let us know in the comments below. I'm Giovanni, see you in the next video.